Hello everyone, my name is Untitled. Today I would like to present Chapter 12, Administrative Processes and Control. In this chapter, I would like to go through 9 study objectives related to administrative processes. So let's go to the first part, introduction. So administrative processes are transactions on activities that either are specifically authorized by top managers or are used by managers to perform administrative functions in a company. This diagram is representative of overall administrative process. We can see administrative processes could be processed from corporate transaction like intermittent investment, borrowing, and capital transaction before the general ledger processes. There are 3 administrative processes: source of capital processes, investments, general ledger processes. So let's go to the first step of source of capital processes. The operation of any organization requires a long-term capital assets such as land, buildings, and equipment. To purchase these capital assets, top management must have capital available. Capital is the funds used to acquire the long-term capital access of organization. Capital usually comes from the long-term debt or equity. Long-term debt results from borrowing funds via, via loans or bonds payable, and equity results from issuing common or preferred stock. These financial instruments provide the capital necessary to acquire long-term capital assets. Social capital processes are out to authorize the raising the capital, execute the raising the capital, and properly account for that capital. So let's look into this diagram. Uh, the transactions and resulting processes related to loans, bonds, payable, and stocks should be executed um, only when top management and the board of directors authorize them, and use for the resulting capital must be properly controlled. Sometimes top management may recognize the need of raise capital. This need might arise from desire to accomplish organizational goals that require substantial funds, such as expanding the organization, replacing the substantial amount of plant, property, and equipment, or acquiring the other businesses. The board of directors must decide between two general sources of capital funds, debt or equity. Corporations are usually unable to access the stock market directly, and must conduct a sale of stock through an underwriter. An underwriter is a third party that can trust a corporation to bring new securities issues to public market. Investment processes. In many cases, an organization finds that it has more funds on hand than necessary to operate the organization. Management should properly manage the investment of excess funds. Investment processes authorize, execute, manage, and properly account the investment of excess funds. So let's see this diagram. Since most large corporations have complex IT accounting system, the accounting system can automate much of investment processes, including notifying management when excess funds exist. The IT system can forecast future cash needs and future cash inflows by monitoring the expected timing of future account payable due dates and future collection of accounts receivable. Risks and controls in capital and investment processes. For both source of capital processes and investment processes, the important controls is a specific authorization and oversight by top management. The very close supervision of these transactions helps prevent risk of misuse of cash related to capital and investment processes. Generally, the risks are not related to employee fraud, but instead related to management fraud. This doesn't mean that typical internal controls should be ignored, but to any regular controls in place, the company must carefully examine risks related to its capital and investment processes and implement relevant controls aimed at prevention and detection of management fraud. For manual accounting system, the process in which transactions are ported to general ledger is called the accounting cycle. Um, this exhibit 12-5 is a summary of the processes in accounting cycle. So special journals are established to record specific types of transactions. Subsidiary ledgers maintain the detailed information regarding routine transactions. Transactions recorded in special journals and subsidiary ledgers takes place at the time the transaction occurs. Consequently, the special journals and subsidiary ledgers are updated as the processes for the journal occur. Risk and controls in general ledger processes. So let me give you details, some common procedures associated with general ledger. The number one, authorizations of transactions. Whenever the system in manual or computerized, posting to general ledger accounts should occur only when proper authorization exists. In complex accounting system, certain employees are authorized to record specific events that automatically post transactions to the general ledger. The second, segregation of duty. Basically, general ledger functions and posting can be assigned to certain employee by limiting the access to the general ledger functions based on login. User IDs and passwords can limit access to this window to only selected employee as well. The number three, adequate records and documents. In computerized IT accounting system, the audit trail may be made up of electronic images or in files without supporting paper documents or records. So the audit trail could be partially paper-based and partially electronic images. Number four, security of the general ledger and documents. IT accounting system protect record access in different way. For electronic file images, access can be limited through the proper use of user IDs, passwords, and resource authorized tables. These general controls establish which employees have access to specific records. The last one, the independent checks and reconciliation. In an IT system, reports are checked for correctness by printing and cross-checking the reports against each other to ensure their accuracy. Reporting as an output of the general ledger processes, as you know, the information in general ledger accounts provides information feedback for both internal and external parties. External parties such as investor and creditors are summarize accounting data in the general purpose financial statements to evaluate business performance. There are four general proposed financial statements: balance sheets, income statements, statements of cash flows, statements of retained earnings. The internal reports to be provided to managers vary depending on several factors. Internal reports are usually not general purpose financial statements, but they are tailored to specific needs of its management level and functions. The many factors that affect um, to the type reports provided to internal user can be summarized so that they fall into three categories: the type of organization, the underlying function managed, and the time horizon. Ethical issues related to administrative processing and reporting. As in many business processes, unethical and fraudulent behavior can occur in administrative processing and reporting functions in an organization. There are several reasons that unethical and fraudulent behavior could tend to be management rather than employee started. First, in the properly controlled system of administrators and reporting functions, employees do not have access to deleted access or source of documents. Second, administrative processes are tightly controlled and supervised by top management at, as they require specific authorization. Finally, the huge volume of transactions are often generated by sale, purchasing, payroll, and conversion processes. The routine nature and volume of these processes make it easier for employees to hide fraudulent transactions or unethical behavior within masses of transactions. Unethical management behavior in capital sources and investing. When raising capital, it's imperative that investor and creditor be given honest or complete information. Management may sometimes try to hide negative information when borrowing funds or selling stock to coerce investors or creditors into making decisions in a company's favor. Internal reporting ethical issues. When management places heavy emphasis on profitability, the result may be unethical behavior, such as manipulating numbers to show the higher profit. Many companies use a balanced scorecard approach to internal reporting, whereby measure performance based upon such factors as financial success, customer satisfaction, internal efficiencies, and growth. When companies are in several measures, including non-financial measures, there are less pressure on management to focus only on financial statement numbers. As a result, unethical behavior is less likely to occur. So the last study objectives is corporate governance in administrative processes. Uh, the internal controls and ethical tone and procedures within the administrative and reporting processes are part for corporate governance structure. Setting and monitoring goals um, setting and monitoring financial goals and establishing and maintaining reliable accounting journals and ledgers so that performance can be properly reported are very important to effective corporate governance. Furthermore, internal controls and ethical practices within administrative processes help ensure proper financial stewardship of a company's administrative resources. So I just went through 9 study objectives of chapter 12, administrative processes and reporting. So I'm very happy to see you guys bring out more questions for discussions now. Um, thank you very much, Professor, and thanks for attention.